Welcome to this video on day trading for a living. One of the most important things when it comes to day trading for a living is managing your risk. You know, I hear so many people talk about, gosh, Barry, I blew out my trading account and I don't have any money left. They email me telling me at Top Dog Trading, well, I've been with some other trainers, or I've just learned on my own, or I bought an ebook and I've tried to teach myself trading, and now I've lost, X amount of dollars. And the X amount of dollars is usually a ridiculously huge amount of money. And that you really got to guard yourself against that. As professional traders, yes, we are interested in good trade setups and indicators and price patterns and all that sort of thing. But really, above all of that, what we work with is money management and risk management to keep our losses small and make our winners big. So you've heard that phrase before, keep your losses small, let your winners run. And that's so you get a good risk-reward ratio. But how do you do that? So I'm going to give you some practical day trading tips on how to do this, because this is really what you have to do in order to start day trading for a living and make a significant amount of money consistently and have that equity curve climb. All right, so let me give you one tip today. And what we're going to do is we'll go to this bar. So this right here, by the way, don't have time to go into what kind of setup this is, why we're taking this, but that part doesn't even really matter right now. So the point is, anytime you find a setup that matches the trading rules of whatever method you are trading, all right, this happens to be one of mine. And this is a great one. I love this trade setup. It's beautiful. And so what we're going to do is we're going to enter one tick above the high of this bar. And then we're going to put our stop one tick below the low of that bar, because this is a cycle low. It's one of my cycle low patterns right there. By the way, if you're interested in learning more about the cycle indicator and the patterns that we trade on it, feel free to send me an email at barry@topdogtrading.com, and I'll let you know when the next free webinar is going to be, where I give away the cycle indicator and teach you how to use it. But anyway, right now back on topic, risk management. So if we look at this, okay, that's where we're going to enter and exit. So let's put a little, let's click on this. Now, if you look over at the data box on the left, you'll see that the high there is 1201.50. So these are the E-minis. This is a 2-minute chart of the S&P E-minis. So I would place a buy stop at 1201.75. So that's where I'd be getting in. Then my protective stop would be placed at the lowest low in this cycle, which would be the low of the bar previous to that. 1199.75 is the low of that bar, so my stop would be at 1199.50. So the spread between 1201.75 and 1199.50 is 9 ticks. Now each tick in the E-minis is worth $12.50. So therefore, I am putting at risk a maximum of $112.50 per contract. Now, that's per contract, all right? So if you're only trading one contract, that is your risk in the trade from where you're placing your entry to your protective stop. Now, I have to say on the side here, just for, for fair warning, that we don't always get stopped out where we want to. That's where you're placing your protective stop. Nothing's always perfect. Stops can be, depending on what type of stop, whether you use a limit order or whatever, it can go flying right through there and you may not get filled. If you use a market order, you may get filled, but not at the price you wanted. These are all, qualifications for my statement here. One of the ways to help overcome that is to hedge. But again, that's way beyond the scope of this topic today. I just need to throw that in so you're fully aware of that. So here's our planned risk. Now, the key is we want to then look at that risk based on the size of our trading account. So for me personally, I don't like to risk any more than 1 or 2% of my entire trading account on any one given trade. So just as an example, let's say that you only trade one contract. Then at a risk of $112.50 for this trade, if you were to only risk 1% per trade, if that's what you decide to do, that's your money management rule and your risk management rule, that means that your trading account would have to have $11,250 in it, right? Basically 100 times $112.50. Now, if you are willing to risk 2% of your trading account, then you could knock that in half and risk $6,125. Or I'm sorry, you can have a trading account of $6,125 and be able to take this trade with a 2% calculated risk. So what I'm saying here is that you really want to manage your risk by looking at how much am I risking on each trade in relation to the size of my trading account. And I don't have time to do this today, but what I do is I'll look at a time interval like a 2-minute chart. You can do this with a 1,000-tick chart, whatever time interval you're using, and go through and look at a bunch of your entries, whatever your entries are for your trading method. And I would go through about 20 or 30 of them and do this for each one and see what the average risk per trade turns out to be. Then use that, the average risk per trade over about 30 trade samples or more. You want to use more rather than less to get a more accurate reading. And then you'll know, okay, here's how much I can risk. Now, this is going to determine two things. Number one, how much you can risk on each trade based on your trading account size, and then also perhaps how many contracts you can trade. Trading one contract is pretty hard to do and make money. So I would say, I don't like to trade any less than 2 contracts. Of course, I trade a lot more than that now, but just because of money management principles, as I'm in the trade, I like to take some profits quickly, lock in some money, move my stops up to break even. And so if I'm only trading one contract, I can't really do that. I've got to be like perfect every single time, which is nearly impossible. So now if you're trading 2 contracts at a 2% maximum risk on each trade, well, then you'd have to have that $11,250 in your trading account. So that's one of the ways that we do it. It's very, very important. Now, one last thing that's also critical, absolutely critical. It pains my soul when people call and tell me or email me and say, Barry, I blew up my trading account, or, can you help me if I take your courses? Can you help me get it back or whatever? Wow. Here's the problem. They were not taught the things that I teach in my courses and that I'm teaching you right now about money management. So not only do you need to have a protective stop on every trade, you also need to have a protective stop on every day you trade, on every week, on every month, on every quarter, and every year. So, for example, let's say that in the percentages you decide are up to you. I would never risk more than 2% on any one trade. And then I would never put at risk more than 5% on any one given day. That even makes me nervous. 5% of my trading count on one day, that's huge. Never, never, never. So if you get to a 5% loss of your trading account on one day, you're done. Shut down. Now, again, these numbers I'm not prescribing as good numbers for you. Keep these numbers smaller, the better. All right. And then let's say at the end of the week, you lose, maybe 7% would be your max. You don't want these to be proportionate each day. You want them to be smaller. I'd prefer something like 1% per trade, and then maybe 3% per day, and then 5% per week, and then maybe 10% would be my maximum allowed loss for a month, and then each quarter, maybe 20%. And then per year, maybe 30%. I mean, these still are huge numbers. Hopefully, we're not going to hit them, but they're there to protect us so that you never blow out your trading account. You hit those percentage losses, you're done. If you hit your percentage loss for the day, maximum loss percentage per day, you shut down your account. Let me tell you from a practical point of view, do not sit there and watch the market because the temptation to take more trades is way too great. You stop, you shut down your account. You totally take down your charts. You do not look at them. You remove the temptation. If you hit your weekly stop, say that's 5%, and you hit it on Tuesday, you're done for the rest of the week. You do not trade Wednesday, Thursday, Friday. If you're going to watch the market, you put your account in demo mode or simulator mode. Don't even allow your order entry to be up. And then and the same thing applies. You get the idea. So if you lose, it might be at the end of the first week, you lost your maximum amount for the month that you've allocated for the month. Well, guess what? You don't trade for the rest of the month. Because if you hit those numbers, something's wrong. Something is wrong, and there is no reason to keep trading because you will continue to go down the rabbit hole deeper and deeper and deeper. So this is just one simple step, one practical simple step in preserving your money, not blowing out your trading account, not allowing yourself to blow out your trading account. And here's the other thing. Hopefully you won't, but if you hit those percentages on any one of those, stops per trade, stops per day, stops, weekly stops, monthly stops, quarterly stops, annual stops, that's sending you a message that something's wrong. Something's wrong. You need to go back and regroup. Stop trading with real money. Go back, regroup, maybe get a coach or a mentor, or at least analyze your own trading and find out what is going wrong, because there's something consistently wrong. You're having a consistent problem at that point. And do not put your money at risk. So, that's it for this lesson. Very important lesson. Hope you appreciate it. Hope you apply it. Please, for your own sake, stop sending me emails. Stop sending me emails saying that you're blowing out your trading account. But you could do it if you want to, but I'd rather you actually applied this and say, Barry, thank you. I applied these rules, and guess what? Now I don't blow out my trading accounts anymore. In fact, now I'm making money. The other side of it, I'm going to throw this in real quick too. A part of what this does, here's a side benefit. When you apply these kind of stops per trade, per day, per week, per month, per quarter, a side benefit that it can have is to make you more careful on the trades you take. To take what I call fewer, better trades. When you know that you're only going to be able to take so many trades in a given period, it can, I won't say it always does this for everybody, but one of the psychological benefits that some people experience is that they get more selective and more picky and more conservative with the trades they take. And that has an extra benefit of giving you a better win-loss ratio and helping you to stop over trading, which I would guess is probably about one of the number one problems that I hear people having is over trading. So be more conservative, be choosier, and as they say, take fewer, better trades. And believe me, you will be happier. So, if you liked the video today and you're watching this on YouTube, please click the thumbs up icon below. And also, I'd appreciate it if you leave a comment telling me what you'd like me to cover in future videos and what you liked about this one. Also, I'm giving away one of my favorite trade strategies, absolutely free. It's called the rubber band trade, and it has an extremely high win-loss ratio. It's a very simple strategy. You can learn it in about 26 short minutes. So get that video explaining the trade strategy absolutely free by clicking on the image in the top left corner, or if you're on a mobile device, click on the little eye with the circle around it in the top right-hand corner of this video. Once you do that, I'll personally email the video to you.